Welcome to the Brent Bruce Daily, our first report for 2023. Today is January the 3rd, 2023. It is now 2:31 p.m. Central Time. We're going to take a look here and take a look at where we started 2022 and where we ended 2022 to kind of see how that ride went. We all know how it felt, but how did that ride go? A little bit of why all of that happened. And then again, still be on the lookout because I will have my report, my projections for 2023 coming out here shortly. I expect to have that out by the end of day tomorrow, but I have had some new charts come in and reports come in that we've been kind of adding. And I want to make sure to have some illustrations for you to see why we think what we think. So that takes a little bit longer. So we're going to take a look right now at the ride that we went on in 2022. Then we'll look at the charts of today and where we are on our interest rates on our first day of 2023. So let's jump over here to the chart. Okay, so this is 2022. Started the year here. Everyone was happy. Rates were low. Things were moving along. 3.423 was the national average for the 30-year fixed conforming conventional home loan. Now, again, that's not the Brent Bruce daily interest rate. As you all know, our rates are usually a little bit lower than that, but that's kind of the national average. So that's a conservative number to go with. So then all of a sudden you see the rates start creeping up. Now understand, this is not because inflation started happening. Inflation was already there. It's just that the reports started to come out that reflected the numbers of inflation. So now the Federal Reserve, or those that look at numbers and charts, were starting to see inflation showing itself on the reports. Well, all of a sudden interest rates start to rise. And you can see that we were going up pretty rapidly. We were pretty upset when we got into the fives, if you remember that. Then we were talking about being in the sixes, starting to wonder, oh no, when is this going to end? Kind of dip down a little bit, push back down below that 6%, then blew right through it and went all the way up here to our peak on October the 24th, 2022 at 7.159%, kind of back up to that range again. Drifted down here and got down into the 6.2 and then kind of have been going back up. Now, first of all, so you're going to say, of course, 7.159 was not the high of 2022. That is correct. That is a national average, and the report that I just showed you does not factor in discount points. So we all know that many banks were offering rates 7.5, 7.75, probably even touching close to 8% with no points. But the interest rate that was actually being sold was usually including discount points because loan officers and banks were putting discount points on almost every single loan in order to combat those high rates of interest when they're talking to their clients. They don't want to say, hey, it's 8.125. They'd rather say it's 7.25 with 1 point or with 1.5 points. That was more palatable to the buyer or the client. So that's why you're seeing the high being less than what we remember the high being, is because the discount points are being factored in. The same kind of thing with the end of the year where we were showing the rates drifted back down to about 6.25%. Well, we all know, watching the Brent Bruce Daily, that we were offering a 5.875 at one point at the end of December. Now, why are we still not at 5.875? Because everything is based on and tied to inflation right now. And the federal government announced a plan to inject $1.7 trillion into the economy. When that's going to actually happen, when that money is going to filter into the economy, we'll have to wait and see. But just hearing about that is so ultra inflationary that it turned us around. We were headed down and it turned us around to bringing our interest rates back up to where we are now. So let's take a look and see where we are now. And there's a pretty cool chart. If you want to ever get a chart like this, anything that I'm showing you, let me know. I can send you an image of it for you to study and digest. So let's go over here to where we are on our charts right now. Okay, so we're starting the first day of the year off, up 13 basis points on the mortgage-backed security that we've been following. The 10-year Treasury is down 4. Both of these are good things, but take a look over here at this red lock. This lock indicator lets us know that we opened the day almost up 40 points. And at one point, I saw us down quite a bit. We were down, I want to say it was like 18 or something like that. And we've climbed our way back to being up 13. So a pretty volatile day and not really that positive of a day for being the first day of 2023. Again, we are being told this is still the aftershocks of the $1.7 trillion spending bill that apparently passed. So let's take a look over here where we are in our Fibonacci levels and our averages. So right now we bounced off of this floor of support, which was the 50-day moving average, kind of in between the 50-day and right now the 100-day moving average here, kind of looking for some direction as to where we're going to go next. The 10-year Treasury, same kind of thing. It's important for us to pay attention to the 10-year Treasury, and we're going to talk a lot more at length on our projections that's going to be coming out here, our other report that's going to be coming out soon. You can see that we're really just sitting on this floor of support. Remember the 10-year Treasury chart, we want to break below. We want the 10-year to go down, which is where we were a little bit ago when our rates were looking pretty strong. We were close to that 5.875. If you remember, where is it that we want to traditionally sit? About 2% above the 10-year Treasury, which would have put us at 5.4. We were never at 5.4. We were at 5.875 at best. So we're going to talk again at length as to why that is the case on our projections report coming out soon. So where are we on our actual interest rates as of right now? The Brent Bruce daily. Let's look at our scenario, which is our very well qualified 30-year fixed conventional 800 FICO score, 25% down, the best of the best today, starting the year off at 6.5%. Now, that's better than 7.25. It's better than 7.5, but it sure isn't the 3.5% that we started 2022. So we need to find out what to expect for the coming days and months and when we're going to start to see buyers more comfortable with their monthly payments. If I open this up and I take a look a little bit closer, 1 point is getting us to 5.99, which is really quite a benefit to us because if you remember, we were at about 1.5% to get to 5.99, I believe like on Thursday of last week. So this is good news to see us moving in that direction. So what are we going to be doing here? We're going to take a look and see at some, again, the projections report that's going to be coming out here. Hopefully tomorrow, I'll put a lot of time into that, try to get it to you. And you're going to really begin to see what we think is going to be happening, especially through the first half of next year. And just want to let you know, you're probably going to be very happy and excited. And I'm also going to end it with what I think you should be doing from a business perspective with your time. So be on the lookout for that. I'll talk to you again soon. Make sure that you like, subscribe, share, comment. Let me know your thoughts. I will talk to you again soon.